There's a lot of uncertainty entering the fall of 2023, both with regard to emerging markets and future Fed interest rate hikes. To answer some of those questions, we have the pleasure of being joined today by Thomas Hayes, who's the chairman and managing member of Great Hill Capital. Great Hill Capital's a hedge fund firm located in New York. And what they do is they primarily focus on assisting accredited investors and institutions in managing their long and short positions in equity. Tom is also a pleasure for me to share with you. Tom is also the host of Hedge Fund Tips, which is a videocast that airs regularly and has been ranked number one as a podcast in the hedge fund category by FeedSpot. So, without further delay, Tom, welcome to the program.
Thanks so much for having me, Patrick. Honored to be here.
Yeah, it's a pleasure to have you, Tom. What I wanted to do is start out really by, stating a lot of our viewers, including our current viewers, are active military. And so a lot of the discussion that we're going to have, I may ask questions, and as you may know, that in a certain degree kind of move in that direction to some degree, or at least are tailored for them. But most of the work most of the discussion we're going to have is going to be for the broad market, right? Even for those who aren't in the military, this information is very, very valuable. So what I wanted to do, Tom, first was start out with kind of your background. I know I mentioned Great Hill Capital, but you, amongst many experts in finance, particularly investing, have been particularly bullish in the last several months. I've followed your work, and it to a certain degree is at odds with many people or many quote unquote experts in the industry who are very bearish. Do you have a number of reasons you feel that way? And I know that you're very data dependent, but what's your perspective on the market in general right now?
Yeah, well, thanks so much for having me, Patrick. I'm honored. Thank you for your service, and thank you for many of the viewers who are serving in the military. Without them and you, we wouldn't be here and have the freedom to do what we do. So that's the most important thing. As it relates to the markets, we became excessively bullish in October of last year, and listeners can go to our website and see our past, as you mentioned, the Hedge Fund Tips with Tom Hayes podcast videocast, and you can see it all the way back. We leave them up forever, so you can go back in October and see what we're saying. When the market was down 27%, the S&P 500 peak to trough last year, most very big name hedge fund managers, institutional managers, household names were saying that the market was going to go down another 20%. And unfortunately, that took a lot of people out of the market at the exact wrong time, meaning they sold the bottom. And that's why they've been so reluctant to kind of buy the top. They're waiting and hoping the next shoe will drop so they have an opportunity to get in at lower prices. And the bad news is they're probably going to be waiting a long time. And the reason they're going to be waiting a long time is that most institutions had the exact same problem. They were excessively pessimistic at the exact wrong times. And they still have more cash than average than they ordinarily hold over the last 20 years. And what we're seeing, like we saw in the month of August, these 3 to 5% pullbacks are going to have to be bought. And why are they going to have to be bought? Because of job risk, because of career risk. So the S&P was up some 20% through the end of July. The Barclay Hedge Fund Index was up only 6%. So there's a lot of work to do for these managers. And I think, Patrick, the name of the game for the rest of the year is going to be different than the beginning of the year. The beginning of the year was largely driven, certainly the first 5 months was driven by what we call the Magnificent Seven, kind of the large cap tech stocks that everyone knows, the Alphabets, the Amazons, which we own both of those, by the way. We bought last fall when no one wanted tech. Right. The Teslas, which we don't own, the Netflix, et cetera. The names, Meta. And I think in the second half, if you're a manager that's underperformed because you bought this pessimistic narrative, you have to put your money in the areas that have not performed to date. And just looking at the All World Country Index, which is all the stocks from around the world, 48% of those are below their pre-COVID highs. So there's still a lot of opportunity and still a lot of things to do, even if you feel like you missed the rally off the lows in the general indices.
So if I understand you right, Tom, what you're saying essentially is the Magnificent Seven, the large tech, the large cap tech stocks performed very well in the first half of the year, but you're not anticipating that they will do as well in the second half. Not to say that they'll go down, but that they won't perform as well as some of these other smaller cap um, businesses, small cap tech, maybe even small cap value too. Um,
Yeah, yeah. I
what
think I think that. Go ahead, Patrick.
I was going to say, what in particular, like what is there a particular area of small cap, at least domestically, we'll start domestically first, that you think has the most upside potential?
Yeah, well, we're in a regime change, and the regime change is that the Fed is winding down its tightening cycle. If you look at the Fed funds futures, the odds of a rate hike in September have collapsed down to 7% following the jobs report on Friday, and the odds of a November hike have come down from some 48% down to 35%. And the result of this is going to be in coming months two things that very few people are positioned for. Number one is weaker dollar, and we can get into that a little bit more when we discuss some of the opportunities outside the U.S. And the second overriding theme that we have in our investing framework for the rest of the year is very unconventional and contrarian, and that is we're going to see a bid in bonds in the 10-year note. So bonds are going to go up and yields are going to start to compress, and that's really going to help when we're talking about small caps. More than 20% of the index is financials, which is small banks, and everyone's worried about small banks right now because of their loan portfolio, because yields have gone up so quickly and given them bad marks on their portfolio and on their loan book. But that's all going to change very shortly. Two things have happened. Number one, you had $1 trillion of supply come on the market in recent weeks, and that should be winding down in coming weeks. So that excessive supply has kind of pushed yields up in the short term. But number two, you have hedge funds and large speculators, the most short that they've been the 10-year Treasury note since 2018, which was the last time we had a major low in 10-year Treasuries, which means the last time we had a spike in yields right before bonds started rallying. And if we see bonds rallying, that's going to help the small caps, but it's going to help financials, which is a big part of that index. And we think that's going to be tremendous opportunity in the next 6, 12, 18 months from our viewpoint. I do want to caveat everything, Patrick. Number one, as you said in the beginning, we deal with accredited investors and qualified institutions. So their risk parameters are different. And for individual investors, you probably want to consult with a financial advisor or just do this with kind of money that's not important for you. We're not giving advice. We're just sharing what we're doing for ourselves and for our clients that may have different needs and requirements than some of the listeners on this call.
Right, of course. A very interesting perspective you have on this, though, Tom, is that you foresee a bid in the 10-year here in the coming few months. And that seems to be, again, a very kind of contrarian view, whereas you hear a lot of commentators saying rates are going to keep going up.
Yes.
And I guess my question to you would then be, let's say you're correct, and that we see a surprise bid in the 10-year. Would that essentially encourage the Fed to redouble their efforts at raising rates? Like, would that essentially put a support under the housing market? Housing seems to be kind of the big driver of inflation, or at least a big component of it. And not having housing prices come down, I think, has to some degree contributed to inflation remaining sticky. Would that bid in the 10-year kind of bolster the housing market to a certain degree and make the Fed's problem harder?
In some degree, the housing, number one, housing is a major component of CPI, headline inflation. That's what they're kind of dealing with, and core inflation, et cetera. the owner's equivalent rent component, that's close to 40% of it, works on a 12-month lag basis. So we're going to continue to get better and better numbers on the inflation front. As it relates to the housing problem, that's an issue of supply and demand. I think that is going to be solved predominantly by home builders actually putting supply on the market. So now that you're seeing some of the input costs normalize, you're seeing actually in the jobs report, average hourly earnings start to flatten out, giving a little bit more power shifted back to the employers, which means they'll be able to get more people labor at a reasonable price. I think you're going to see a lot of supply, and I think the dynamic is going to change. Not every 32-year-old that's starting a family needs a 5,000 square foot house with 4 bedrooms. Right. I think we're going to see a tremendous amount of supply. If you think along the lines of the home my parents raised me in, 2,000 square feet house that's more modest, or even if you think of Levittown following World War II, where they were 1,000 square foot houses, starter homes for people to move out of the city, start a family. We have the biggest part of the population right now is the millennials, which are, on average 31, 32, 33. And if you look through history for the last 100 years, the biggest spending in someone's life comes between, 31 and 40, when they're buying a new house, they start a family, they move out to the suburbs, then they've got to buy a dishwasher, they've got to buy a refrigerator, they've got to buy a car. Oh, now they've got to buy another car because they're commuting to work, and then they've got to buy cribs, and then they got to buy clothes, etc. So there's been no instance that we found over the last 100 years of a country that had the bulk of their population between 31 and 38, where they didn't have, number one, a booming economy, and number two, a booming stock market. That's the good news. The bad news is when they turn 40, bad things happen. So
Right.
we saw, the example would be in 1991 was a similar situation where the boomers were in their early 30s, and by the time they turned 40 in 2000, what happened next.
Right.
Japan had a similar situation in 1989 when they turned 40, and what happened next. So we think that we have secular tailwinds for our economy domestically and growth.
Okay. Translating this a little bit to an individual investor, I know that a lot of the topics that we're discussing could be places they put their money that is a little bit more speculative. But are there any areas, for instance, we're talking about bonds? Would you recommend, if someone wanted to capture some of those gains, would it be a smart move, say, with someone who's got a long time horizon, to increase their exposure to a bond portfolio, or would you not mess with that kind of long-term investing strategy at this point?
Yeah, well, it's again, it's going to depend on a case by case basis, but I can share what I'm doing for my clients and what I'm doing
Sure.
personally, and then your viewers can check with their financial advisor, et cetera. In terms of bonds, the instinct with what I'm saying is, well, if bonds are going to go up, I should buy bonds. I think there's a better way to play it. Now, if you have exposure to bonds, you're probably in short duration, meaning 1 to 3 years, intermediate term, because you were afraid of rates going up and you played it correctly. Now's the time to start to move out on duration and lock in these yields, because they're not going to be this rich for a long time. And that's another reason we believe there's going to be a tremendous bid from pension demand in the next few months before the end of the year that have long-term liabilities, going to want to lock in the 10-year, the 30-year at these abnormally high rates while they can. And that's why you're going to see the bid after this $1 trillion of supply gets soaked up and there's no more supply, then we're going to see them bid. Now, how do you benefit? We want to benefit from those equities that have been smoked on the basis of this excessive tightening cycle over the last year and a half. Some companies like Citibank, for instance. Okay, Citibank is trading at, or Citigroup is trading at a 40% of book value, meaning a 60% discount to its liquidation value. If the business were to be closed today and sold, you would, for every 40 cents you invested, you'd probably get about $1.
It's a good return.
Those type of margins of safeties are very rare. We had instances of this during the pandemic lows, and we made a lot of money on Wells Fargo. You can go back and look at our notes and our podcasts during that spring and summer period. Wells Fargo is not a tremendously well-run franchise. I'll be candid with you. But they are in a turnaround. I think Jane Fraser will deliver, or she'll be replaced. Their expenses are too high. They have a 69% efficiency ratio. So I'm kind of telling you why the stock's down. They need to get down to a 63. But they are selling non-core assets around the world and raising cash. And that cash is going to be used to buy back stock, okay, which is going to reduce the amount of slices in the pie. So your slice is going to be worth more. And, you know, not only is it trading at 40% discount to book, 60% discount to book, 50% discount to tangible book. It's trading at about 6.8 times next year's earnings. That compares to normally trades around 10 times forward earnings. And in a banking cycle, we're at a trough here for some of these banks where they trade, you know, they can trade below book value, which in this case is trading dramatically below book. But peak cycles, they can trade up to 1.5 or 2 times book. So we think if you look 12 to 36 months out, plus we've got the M&A cycle coming back. You saw all the headlines today about ARM Holdings. You saw Kava over the summer. Instacart's lined up. There's a ton of them lined up. Once the game's on, all of that, the capital markets have basically been closed for 1.5 years because of the market sell-off last year. As that reopens, these money center banks with investment banking franchises are going to mint money. And also as bonds get bid, you're going to see a lot of issuance in fixed income as well as equity, primary and secondary. So I think they're well suited to do that. And the second one that we like, we have suggested, I know you followed our podcast, we've liked REITs when no one liked it because most of these REITs, their revenues have not been impaired at all. Their funds from operations have been pretty steady, but all of them have been smashed by 50 to 80% because they trade inversely with rates. As rates go up, they get pounded. Not dissimilar to utilities, but it's more pronounced in REITs. We think that's at the end. So this is a leverage play. We like Crown Castle, which has 40,000 towers for cellular data. The demand for cellular and data is only going up. They've got a huge toehold in the US markets with 40,000 towers. You get a 6.7% dividend while you wait. That dividend grows about 7 to 8% a year. Oh, and by the way, you may wind up with a double over the next 2, 3, 4 years as this reverts back to normal pricing and historically normal. And you see this over and over. It happens, it's happened 2 or 3 times in the last 30 years, and this is one of those opportunities.
Tom, that's actually an interesting point you bring up, because I think when a lot of people think of REITs or even just a real estate in general, they think of commercial and residential. And they think, well, commercial's not doing so well, so I don't necessarily want to be involved in that because I've heard in the news that it's not well, whereas I want to be in residential. Whereas what you're bringing up with Crown Castle, it's unique because you're right. Yeah. Telecom's not going anywhere. In fact, there's probably demand is only going to go up. And
it's funny. The commercial is consensus, and I was going to talk about Vornado, which is what everyone hates is commercial real estate. The problem is we started talking about it when it was $14 and $15, and it's up 73% in the last few months. While everyone's still worried about commercial real estate, the A properties are flying. So I didn't want to pitch that after it's up. But I think Crown Castle is not up, and that's one that is new for us and we think is interesting. But you got to take a long-term view. When you're buying, it's funny. I was on last week on the New York Stock Exchange floor on a TV interview, and the lady said, "Well, what if I had this trader on yesterday, and they said if Citi breaks below 40, it could be it could go all the way down to 37." And she goes, "What would you do in that case?" And I said, "So wait, you're telling me this business is trading at a 60% discount to liquidation value. If it trades down to a 63% discount to liquidation, what would you do?" I'd buy more shares if I had money. So at that
Exactly.
point, so
Right. Yeah.
if you think about it from a standpoint of owning a piece of a business versus a piece of paper with a price attached to it, but actually a business. If you own 100 apartment units in a few buildings, and the revenues have stayed the same, and the net income to you has stayed the same, but real estate is out of favor because of rates or whatever, but your economics haven't changed, and the buildings are worth $30 million, but today no one will offer you more than $12 million, would you take the bid? And the answer is no. You would laugh the person out of your office. But
Right.
in the public markets, people sell their stocks in those situations every single day, and when those opportunities avail themselves, no one wants to touch it because of all the headlines about commercial real estate or about this or that. I'm not saying there's not problems in commercial real estate. There are. The key is to distinguish from the noise and know that the cream will rise to the top. Just like the malls, the A properties did great, B and C had some trouble, and you just want to stay away from the B and C.
Yeah. That's kind of a deep insight into buying and selling equity, because it's like you need to think of it like you said, think of it like a business. And I think probably younger people still view it as a bit of a speculative game. They buy something hoping that the price is going to go up without really knowing anything fundamentally about the business itself. And
Yeah, and
you
and
know,
there's one more trick is if you're worried about the paper prices and trying to get rich overnight, the problem is you're going to give half your gains to the government. If you take a
right.
long-term view and you take 12 to 36 months, you're taxed at a much more favorable rate, long-term capital gains, and then you get to actually keep the fruits of your labor and your intellectual capital versus giving half of it away, and more likely than not churning up your account.
So, Tom, I want to shift gears here just a little bit, and talk a little bit about emerging markets, because I know that's a specialty of yours.
Yeah.
At least that's an area of interest of yours, or you've talked about it quite a bit. I know right now that emerging markets, parts of them have gotten hit. They've been down, particularly in China.
Yeah.
And I also know that there is potential, and you believe there's a lot of potential in this area. Can you
Yeah.
give kind of the viewers a little bit of an overview of what parts of the emerging markets you think have potential, and why?
Yeah, so this is the same theme as everything else. It's like if the underlying fundamentals are improving and price is not, or even going the other way, that's where you have asymmetry in taking risk, in benefiting from these rare periods of dislocation where abnormal returns can be gained for those people who have patience to withstand the short-term volatility. I mean, emerging markets in China, we have a big position in a company called Alibaba. They, on a day-to-day basis, it would drive you crazy and you'd pull your hair out. Basically, they've been going through a bottoming process for the last 12 months, and they've made effectively no net progress. But on a day-to-day basis, you would think the world had come to an end. All the people had ceased to exist. There would never be any business done ever again in the emerging markets, and that their population had a declining setup. And the exact opposite is true. Even in China, which is set up to have a 1989 Japanese style lost decades. The problem with that thesis is they're 5 to 7 years away from that happening because their echo boom right now is about 33 to 35, the bulk of that secondary age group that is a large part of their demography. So we believe they have another 3 to 5 year parabolic run in their economy as they come out of COVID, which, by the way, for them, because they mismanaged it, only ended in January, February, when people were rioting on the streets and the government finally relented and said, okay, we'll unlock you out of your apartments and you can go about your business. I mean, you can't make this stuff up. But like all governments, they make the right decision after exhausting all other possibilities. And as it relates to stimulus, this time will be no different. They're kind of trickling out in China, mini rate cuts and little bit of help for the property developers and this and that. And they do the same thing every single cycle. They do the absolute minimum until they have no choice but to pull out the bazooka. And it's our view that they're going to have to pull out the bazooka to re-stimulate growth because of massive mismanagement of COVID over 2 to 3 years. And if they don't do it, the same thing will happen that happened with the COVID lockdowns. You're going to see a bunch of those 20 to 25-year-olds who went to college and thought they were going to work for Alibaba on the street angry because they don't have a job, and you got 20% youth unemployment. And all of a sudden, the Chinese government will realize if we don't do something quickly, we're going to be probably carried out of here against our will. And that's the last thing you want, is a bunch of 20% of your population educated and angry, displeased with your leadership. You want to appease that very quickly, and they're going to have to do that probably in the coming months, if not sooner. But leaving that aside, there's another group of people that makes the case that actually, despite all the headlines, things aren't that bad. Maybe they don't need to stimulate. And I sympathize with that view. I just don't think the government is going to risk it in the sense that if you look at China tech earnings, they had the crackdown last year. They ended the crackdown earlier this year. You saw a massive rally from October till about January, February. Then it's been sideways chop as the reacceleration hasn't happened as fast as everyone wants. But in aggregate, the top handful of China tech companies, the Tencent, Alibaba, Pinduoduo, the names, this quarter alone, EBITDA in aggregate was up 30% year on year. Revenues were up 7%. You would never discern that from all the negative headlines you see. As a matter of fact, this group Sentiment Trader, I saw put out a chart. The negative mentions of China in the media are at an all-time high, and they measured it. It was like something like 30,000 or I don't know how they actually do it, but they had the data back like 20 years, and you could see the spikes. And invariably, without exception, or few exceptions, every time you saw the negativism in the media relating to China this high or close to this high, it's never been this high, you are at or near inflection points. And it's not dissimilar, whether it's commercial real estate, whether it's REITs, whether it's banks. You need to, basically have everyone exhaust all the sellers before you can actually get back to fundamentals. In the short term, the market is a voting machine based on emotions, not logic, like we talked about the logic of the apartment buildings. But in the long term, it's a weighing machine based on fundamentals. And sooner or later, price always reverts back to intrinsic value. And just like it overshoots in periods of despondency, like you're seeing right now in China, it actually overshoots in euphoria. And we'll probably see that in China, believe it or not, over the next 36 to 48 months. No one can see it right now, but it's coming.
Okay. So this is interesting. So let's say we are at an inflection point, like you are saying right now, based on data. What would be, so a lot of, and I'm going to use military service members as an example here. I know, again, there are a lot of viewers who are not military, and we can apply that to their situation too. But in the military, there is a program, actually it's in the federal government, called the Thrift Savings Plan. And they don't really have an option in their retirement fund to get any kind of exposure to emerging markets. Yep. Is there a particular ETF or index that you think gives them a good exposure to emerging markets in a way that would be a good long-term play? Well, one that I can think of personally is like VWO, Vanguard. It's really inexpensive. It seems to be very broad-based, but that's just like my opinion. Again, I'm not pitching them to anybody here in the audience. Again, talk to your financial advisor, Tom said. But what are your thoughts on that, Tom?
Yeah, I agree. I think VWO is fine. I think EEM is kind of the benchmark one that's a little more expensive. They're probably basically interchangeable. China is about a 40% weight in both of those, so give or take high 30s. So you're going to get a lot of exposure there. And then if you wanted concentrated focus on like China Internet, which is where we see the greatest risk reward benefit, you could do something like a K-Web, which has your Alibabas, your Tencents, your Pinduos. That's a China Internet ETF run by Brendan Ahern. But for us, we like to pick companies, and we think that's where we deliver extra, and we try to. We don't want to take both country and company risks, so we try to buy the highest quality companies during periods of dislocation. Just like in the commercial real estate, everyone hates commercial real estate. We bought the highest quality, we believe, the A properties in New York City, which was Vornado. So now that's up 73%. We are looking, in terms of China, we believe the best opportunity with the greatest optionality is Alibaba. Personally, that's what we own. We're not suggesting that anyone owns it, but that's what we own in size. And the reason we own that in size is because they're breaking the business into 6 parts. We believe that the cloud growth is just beginning. They're probably, Ali Cloud today is where Amazon Web Services was in 2016. They're 5 years behind us in terms of digitization. You get the AI kicker with large language models and all the app overlays that they're going to have to their cloud customers moving forward. And by the way, you're getting a recovery with Tmall and Taobao as people come out of COVID, and you get all the pent-up demand, and then you get all these other pieces for free. Plus, you have 30% ownership in Alipay or Ant Financial, which is one of the largest financial services providers in Asia. So we think that's very interesting. And what's really interesting from our point of view, we're just like to think about it simply. You can buy Alibaba today for the same price that you could buy it in 2014. The difference is revenues are up close to 1,000% per share. Cash flow and earnings are up both now over 500% per share. So when you can buy something that's grown that much at the same price due to excessive emotional selling and structural selling in the short-term voting machine based on emotion, and then benefit from the long-term weighing machine based on fundamentals, we think that the sum of the parts is worth many multiples of the current price in the market today. And there aren't many opportunities globally that with that high quality that have compounded capital at double digits for more than a decade that can be had. So that's what we do. We buy when things are out of favor. We buy high quality, and then we wait for sentiment to turn, and then we wait for sentiment to get excessive on the other side. And when everyone's interested, all the people who hate it at massive discounts, they all want to buy it at massive premiums. That's when we help them out and we lay off our stock. We're nowhere near that point.
Right. So based on what you're saying, really, is you see, Alibaba right now is a great value play. At least that's the way it sounds.
Correct. Well, it's growth at a reasonable price. There's a huge growth story, but it's trading as a value multiple. That's for certain. And earnings in China in aggregate have been going up steadily since March, and yet the headlines continue to be negative. But that's what creates the opportunity. If it was all blue skies, you'd be paying up. And
Right.
You don't want to be in periods when you're paying up. You want to be in periods when you can buy discounts. Wall Street is the only place in the world I've ever seen when they hold a clearance sale, people run out of the store versus into it. It's mind-boggling.
That's a good point. I never thought of it that way. Do you? Yeah. What would change your view on this? Like, for instance, what you've described as far as right now, China being at an inflection point, maybe at a low. This is a real low where we want to get in. What would potentially change your view on that, or what macroeconomic events could occur, or do you anticipate might occur that would maybe have you shift your approach?
Well, the big thing that everyone points to is China's going to invade Taiwan. And the problem with that thesis is that if China invades Taiwan, Apple's going to be cut in half. So everyone worried about Alibaba down, 2/3 off its high, 66, 70% off of its high. Instead, they want to buy Apple, which is trading at, 27 times next year's earnings versus its historic average multiple of 13 times. People can't get enough Apple at a record high multiple, which would be more impacted than Alibaba, because Alibaba, that risk in our view is largely priced in, whereas Apple, it's not priced in any, and everyone is overexposed to Apple, whether it's through index ETFs or whatever. And what would happen to the S&P if that happened? The S&P would probably be, down 35, 40%, something like that. So I think that a lot of the fears around the worst case scenario, geopolitical event or whatever, as it relates to China, are already priced in and probably won't occur. And if they're to occur, I've talked to many military experts. They said, we're in the unlikely case it were to happen, it would probably be at a minimum 5 to 7 years out. And if our calculation is correct, we're going to ride a parabolic move for the next 3 to 5 years. We're going to be out well before that could happen. But I think that it remains a very low probability scenario. And at some point, if you could be 100% certain, then you would just have, 100 or 200% of your portfolio in one name. You never do that. We own,
Right.
Anywhere from 8 to 14 companies at any one point in time. You can never be perfectly certain. There's always the possibility of things that you don't know. But at some point, when the odds are skewed in your favor, you have to step up to the plate.
Tom, what are your feelings on, with this in view, what are your feelings maybe on some alternative assets? And by that, I'm referring to things like precious metals or even cryptocurrency. I know that you focus, obviously on accredited investors and managing their long, short equity positions, and you're really into value investing. Do you have any in your managing their money? Do you put any of these alternative type of investments or give them exposure to that, or is that something that you generally don't do?
Yeah, we try to focus on cash generative, productive assets. So, in the case of Bitcoin, in the case of gold, um, they don't yield anything. So,
Right.
I'm making a bet that someone's going to come in at a higher price than I paid for it.
Right.
And for me, I'd have trouble sleeping at night hoping for the next bid to come in higher than mine. In gold, I could, maybe justify it and say, well, there's this much gold in the world and this many people want it, and all those Indian people with teeth and jewelry and all that stuff. But again, it doesn't yield anything. If anything, it has storage costs that are embedded in the price. And if I'm buying them to hedge against inflation, um, if I'm buying the most high quality business, we don't buy non-cash generative businesses. We're not the type of manager that buys the next greatest thing and hope that we're right and hope we get rich quick. We buy durable, stable cash flows when they're on sale, of high quality businesses that have a history of compounding capital through cycles. So it's not sexy, but it works, and it consistently works over and over, especially when you're willing to step in when everyone else is puking out. That's when you can get abnormal returns relative to the benchmark on the upside. So gold and Bitcoin, I would say I'm agnostic. I think for some people it makes sense. For us, it's not what we do.
Right, of course. And just so that my audience knows, Tom, how can they reach you? Like if we have accredited investors that are watching, or if we have people that want to get involved, or follow your videocast, what's the best way to reach you?
Yeah. I think probably the easiest is our blog, the hedgefundtips.com.
Okay.
There's a contact form that'll get right to us. Also, you can find the weekly podcast and the videocast. And that's probably the best way. Most of the people that wind up investing with us, they'll come to us and say, I've been listening to your podcast for a couple of months, and I really like your style, and I've seen you make these calls, and I thought they were crazy, and they work out. Da, 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 da. I have some people that call me and say, I've been listening to you for 2 years, or I saw you on Fox Business, or whatever it is. And it's just, I'd rather people get to know me, they understand the investing framework, and then I'm working with like-minded partners that I like and enjoy, and we're going to be doing it together for a long, long time. And we take the long view on everything, whether we're investing in high-quality companies and building a relationship with clients that we're going to be helping and growing their money for a long time. Really get the take advantage of the free information. The podcast offers a tremendous amount of value, as you pointed to. It's ranked number 1 in the hedge fund category. We're very grateful for that. Get to know us that way. And then if it makes sense, you can hit the contact button if you have any questions. We also do an Ask Me Anything question every week, and people put in stocks they want to know about and questions about the markets. So that's a great way to get free value. And then for some people, it's going to click and they're going to say, well, that's all great. I don't have time to figure it out. I'm going to just call up Tom and see if he can help me out. And then for others, they just listen and get the free information and take advantage that way. And either way is fine with us.
Awesome. Thank you for sharing that. Just kind of as to summarize maybe your position, you tell me if I've got this right. over the rest of this year, you see greater potential kind of in small cap, particularly in financials, some financials and REITs here domestically. And then you also see, potential upside in long duration bonds and kind of emerging markets, particularly with regard to China. Would that be kind
Correct.
of a good summary?
That's a fair view. And if you go on the website, you'll see our weekly notes. We have listed by categories. You'll see the videocast, the podcast, but you'll also see commentary, a link, and that has our weekly research notes. And a couple of weeks ago, we went through about 10 or 12 stocks we own that we like, and kind of a little bit of the reasoning behind that. So you'll see it's pretty diversified outside of what you said, but the core themes are exactly what you said. And you'll see how many of those names fit into those themes, which is dollar resumes its softness after this most recent counter trend bounce since July, and bonds up, yields down before the end of the year.
Well, Tom, I think you brought a lot of value to our viewers. So I want to say thank you for your time. I know your time is valuable. And I really appreciate you sharing this very valuable knowledge with all of us. And we look forward potentially to having you back at some point in the future if you're available.
Well, thanks so much, Patrick. Again, I'm grateful that you invited me, and really want to reemphasize my gratitude for the service of all the military folks listening to this call. That means a lot to you, yourself, for your service, and thanks again for having me.
Thanks, Tom. And to the viewers, appreciate you watching. Please remember to subscribe, and thanks again for watching.